We are frequently asked about the dollar index and what it actually is. The dollar index is an index. It's a number actually which measures the strength, relative strength of the dollar against a basket of major currencies which are or used to be its most major trading partners. So these 6 currencies which it is measured against are the Canadian dollar, the Japanese yen, the euro, the British pound, and the Swiss franc and the Swedish krona. So these 6 currencies are what it is measured against. Now as a number, it is in the last 1 year significantly it is up 4.2%, and even more significantly it is of that 2.5% is up just since Donald Trump has been elected President of the United States. So this has a big bearing on trade and industry worldwide, and this is related to the interest rates also. So the Fed, for example, over the last 2 years has been struggling in defining what would be the plan going ahead. And even when it did announce in 2015 what would happen in 2016, it never actually followed up with that, and there was only one rate hike. But now it has gone actually ahead, and December has seen a 0.25% interest rate hike, which they've also announced that there will be 3 more hikes in 2017, and this time it is much more believable because we know that Mr. Donald Trump is going to be in the saddle at that time, and he's very aggressive about how he's going to increase growth, which he says that US growth is looking at a 4% target. And this will be underpinned with tax cuts. There will be a lot of infrastructure spending which will be there, and yes, a lot of deregulation within the United States. So all of this paints a picture where you can expect inflation, and therefore rising interest rates are going to be a reality there. The second number to look at is 103, which is the current number or index which the dollar index is at. Now the expectation is that this year, within 2017, it should move up at least to 107, 108, which means a 5% increase, or even up to 114, which means about a 10.5% increase from where it is now. So what does it mean for us? All other things remaining the same, and assuming that the RBI doesn't intervene, then the rupee by the end of 2017, due to the strength of the dollar index, could go all the way down to 75. That would mean a very good time for exporters, software companies, yes, but it would also impact inflation in India, and our ability to import. Our oil import bill would go up, and a lot of the companies which import capital equipment would be impacted due to this. So net, the dollar index, a very important barometer to be followed, whether it is commodities, currency or equity markets, all of them are going to be impacted by this one item.